Hello and welcome to TheoTrade. My name is Doc Severson. This is the Theo Night Report for Thursday, August 11th. I'm going to start out tonight's report looking at the S&P 500 cash index, and I can't tell you how many people are getting frustrated with this grind. Well, a couple of things here. First of all, they are fighting against the trend. Number one. Number two, they're fighting against seasonality. This is the time of year when we get very little volume, very little conviction behind anything that happens out there, and the market can basically bore you to tears, and you end up reaching for things that just aren't there. Let me give you an example here. When we look at this chart, what we're seeing is, if we do a top-down analysis here, we see an uptrend. Really, since 2009, we see an uptrend which had about 18 months of sideways action. So what we had here was really just a big consolidation pattern here. Markets can correct either through price or through time, right? So we're used to thinking of markets correcting through price like this or like this, but they can also correct through time. And this is the relatively rare situation that we had here between 2014, 2015, and into the first couple of months of this year, is that we saw basically the markets just shuttling around within a 300-point range in the S&Ps, just going nowhere. And yes, everybody feels like the market should have come back down here to 1,500, 1,600 or so and retested that breakout level. This would have made a lot of sense coming from 2,100. There's our bear market. There's the correction. Check. We can check that box off and get on with life. This is what we all wanted to happen because, frankly, it's easier to find value at 1,500 than it is at 2,200. But the market's rarely going to oblige us by doing what it is that we want or, frankly, that we think it should do. In fact, usually it's going to do exactly the opposite of what we think it should do. If you need any evidence of that, go back to the end of 2012 when we were sitting there looking at the fiscal cliff and the sequester, and all of the news was uniformly horrible at that time. What happened from there? Basically a 600-point rally from 1,400 all the way up here to about 2,000 before we started to see any real corrective action. Markets will do what the opposite of what the herd expects it to do. So, of course, everybody within this range here was expecting the price to come down here, especially after the corrections that we saw back last August, a year ago, and, of course, at the beginning of this year. Myself included, I felt that it was a done deal for the market to come back down here 1,500 to 1,600 or so, and I was planning on it. Market had other plans for this now, so it's breaking out to the upside. Now, this can be, as we talked about the other day, this could be a fake out. So we'll see whether or not this occurs. Really, the first test of the breakout will tell us whether this is real. So this would happen if we actually come out here and retest this 2,100 level from above, and then if it slingshots off of there, it's good, right? But even that may be not necessarily in the cards. So we have some fractal patterns here that are kind of setting up here. We've gone over the monthly chart. Now, from the perspective of the weekly chart, here's what we're looking at. It's kind of the same thing in miniature. So the weekly chart's approximately 5 times faster than the monthly chart. And we have the same kind of pattern here. Big, strong move off the bottom, big consolidation in the middle, and it's breaking out higher. And actually, we have the same kind of thing happening on the daily chart. If we look at this, the move off the Brexit low, same move, same consolidation in the middle, and it's breaking higher from here. So we don't have anything in here in terms of trend across these different time frames that informs us that the price should be going lower from here. Now, maybe in the back of our mind, we think that probably it's a little bit inflated at these levels, but the market honestly doesn't care. And in this search for yield, there's basically nowhere else to go around the world. This is what's happening right now. Now, the second part of what I want to talk about is just the character of what we see. There's a great deal of difference between the character of a move that we see like this off the Brexit news, or off here back at the end of January or so in 2016 here, or even some of these moves back here, such as the financial crisis in 2008. Price moves differently when markets are correcting. Now, what I'm looking at here is just a very simple tick chart of the S&P 500. You can see approximately the opening bell was right around here, and what we saw after a few minutes of waffling around was pretty soon we started to see some selling coming into play. And so this is very, very common for the first hour of a bull market positive price action, this sort of Groundhog Day type of market movement where we see some type of gap up. All right, we can even see a gap down to start off the day. But what invariably happens is we start to see weakness come into the chart. And then what we'll see is that weakness is quickly unwound to the upside. It creates this bear trap that we have seen over and over and over again through the years as the market has ground higher. So this is a way of kind of perpetuating this type of price action as we get this sort of short covering that creates the move up to the upside again. So we see this again and again and again. And this is what we're going to see as long as the market is in this sort of Groundhog Day type of price action. We're going to see the market show early weakness either before the market or right after the cash open. And that early weakness is going to get reversed and create that short covering move to the upside. Okay, so we have seen this really since 2009, day after day after day, during most of the time, with the exception of the corrective periods that we have had, although those have been relatively rare. Now, what happens during corrective price action? Well, when we see corrective price action, typically the opposite occurs. We usually start out with some type of a modest gap higher, and then what we'll see is from that modest gap higher, we'll see basically the opposite. We'll basically see a bull trap as people chase after that early gap higher, and then what occurs is that the rest of the day, pretty much it's to the downside. So again, we'll see the opposite type of character when the markets start to turn around and provide us with corrective price action. So as long as this sort of early morning dip gets bought, this sort of Groundhog Day price action, we can expect to see the market sort of grind higher throughout the month of August. When that changes, we'll see an early indication based on the character of the first hour of the price action. So stay tight with us here at TheoTrade. We will walk you through these turbulent times and be ready for when the market does turn, and we'll be ready with bearish opportunities at that time. Thanks for listening. We'll see you in this weekend's report.